All right, we're going to go ahead and get started here. I hope everybody's having a great day. My name is Tyler Braun. I'm the Director of Financial Planning here with the Tranel Finance Group. And today we're going to be talking about debt. And I think this is one of the most, I would say, open conversations that we have with clients as they come in. And I think there's a lot of misconceptions with debt, both good and bad, that need to be, discussed. So today, this is going to be a 20, 30-minute webinar. And I'm going to be diving into the weeds on some specifics of assessing the debt you have. And then I'm actually going to give some real examples that we've run into with clients here over the past few months on just looking at things differently or, outside of the norm or outside of the box to help people get to the next level. So, the title, I really like the title when Jenna put this together of navigating debt, because that's what we're all doing. We're navigating that next path. So just so you're aware, Jenna is on the call with us as well to take questions. I want this to be very open. So on the bottom of the screen, you'll see a Q&A tab. So if you're on a laptop or an iPad, if you click on the screen on the bottom, there's a Q&A button. If you do have a question or a specific piece of information that you'd like me to go through, go ahead and feel free to type that question. Jenna will be there to respond to them or relay that question to myself, and we'll be able to cover it either during the presentation and we'll also set some time along our side at the end as well. So with that being said, we're going to go ahead and get started talking about navigating debt. So the first piece, whenever we look at any type of debt that's out there, is we have to ask ourselves three questions. Okay. Is there good debt and is there bad debt? Assets and liabilities, and then investments versus consumption. So the first piece that you see on here is, I put that good versus bad, and that's kind of black and white. And, I get this question a lot is there something, or is there good debt that can be had? Early on in my career, I listened a lot to Dave Ramsey, and Dave Ramsey talks about how, debt is just this terrible thing. And debt, if used improperly, is absolutely 100% not a good tool if it's used improperly. We have been very fortunate over the past decade to have historically low interest rates that have allowed a lot of businesses and consumers to utilize debt for good. So there is opportunities out there to acquire debt and have it be used for good, where you can leverage that for investments. You can acquire something you otherwise wouldn't be able to acquire and really enhance the, desires of your life. And then there's also bad debt, and most debt, to be completely honest, falls into this. So whenever you're acquiring something, I want you to ask yourself the question, am I buying an asset or am I buying a liability? So an asset is something that can appreciate in value and generate cash flow to your life, your situation. A liability is something that costs you money and takes money away from your lifestyle or your month-to-month bills. So for example, we hear questions all the time. Well, if I buy this car, a car is a use asset. That's a liability. A car typically does not appreciate in value. 2020 was a little different because it was screwy and some cars did go up, but most of the time, cars do not appreciate in value. That would be a liability, right? If you're buying a business is something that generates cash flow. It generates net worth and can increase in value over time. That's an asset. A common conversation we have with people is a house an asset or a liability? And in most cases, a house is a liability. Think about it. You pay property taxes, you pay utilities, you have additional expenses that are going out on a monthly basis because it's not generating you any form of income. Where a home becomes an asset is when you pass away or you sell it. If it appreciated in value, now it's an asset that brought you some return. So have that conversation, and then also dissect for any debt. Is this an investment expense or is this a consumption expense? So people think of credit cards. Credit cards are 0% an investment, right? 100% not an investment. If you're using a credit card, you're typically buying gas, buying food, groceries, whatever it is, that's a consumption expense. So those are three different categories of debt that you would look at and just say, okay, is this an investment that I'm purchasing or is it a consumption? And is this better or worse my situation? The big pieces that I talk to with clients all the time is not all debt is created equal, and not all accounts that you have are created equal. So you can see the title on the screen here, how to pay things off faster, right? Not how to pay things off. Everybody knows that they need to pay off their mortgage. Everybody wants to pay off their car. It's how do you pay them off faster and efficiently as possible? And I'm going to give you three examples here in just a second of how to look outside the box for most situations. So a lot of people, when they come in, they might have $10,000 or $15,000 in credit card debt that they've accrued over the years from an emergency, or just got, things got away from them, put a child through college. They're looking at different avenues and they're saying, I just want to learn how to dig out. For them, it can seem like an uphill battle. And that light at the end of the tunnel just seems so far away that they become unmotivated. And what's interesting is there's statistics that are out there that show that if a person pays off their credit card debt, typically they replace that credit card debt and more within a 12-month time period. And you tell yourself, like, okay, you just did all of this, went through all the pain to dig out. There's typically some other form of underlying issue that comes to the forefront when having that. So I want you to ask yourself the questions that you see on the screen here as we're going through this presentation to really understand, okay, there's different ways to look at this, and there's faster ways to get started that can benefit your situation depending on what you have. So when we talk about debt and assessing it, I listed 4 items here that we see quite often when we're looking at different types of debts that are out there. So number one question we get all the time is just mortgage, right? Most people don't understand how a mortgage actually works. So if you think about it, with a mortgage, and if you take out a 30-year fixed mortgage, most companies do not have any type of prepayment penalty, meaning that you could pay that mortgage off 5 years into your note and they don't penalize you for that. And it's odd that you think of that, right? Like, why wouldn't they penalize me? And most people say, well, it's because they're getting their money back. Well, the mortgage company or the bank makes money when you have that loan open. So anytime you have a mortgage and you run an amortization, so if you looked at an amortization calculator, so if you went to your phone and just downloaded a mortgage calculator, and you pulled up a loan value or a loan calculation, and you run an amortization, and I'm not sure you guys are going to be able to see that or not. There we go. You're going to see that 90 cents out of every dollar in the beginning of a mortgage calculation is paid to interest. So the reason that the bank has no prepayment penalty on a mortgage is because they front loaded all of the interest in the first roughly half of the mortgage. So if you're on year 16 of your 30-year mortgage, the bank's already pulled out 80% of the interest that they're going to charge you. So of course they're okay with you paying off your mortgage, right? You're just paying off the principal because they front loaded the interest. It's the same thing for refinancing. People use that as a tool all the time. I have an associate, I wouldn't call him a friend. I have an associate that I have met over the years, and he drives me absolutely crazy. I have to be honest. And in the reason he drives me crazy is his answer to everything. He's a mortgage broker, is to refinance your mortgage. Just refinance your mortgage and pay off that debt. And in certain cases, that absolutely makes sense. But when you factor in a refinance, what you're doing is restarting that reamortization process all over again. And now 90 cents out of every dollar is going towards interest instead of actually paying down that debt. So in certain instances, it does make sense. In others, it ends up costing you substantially more, sometimes tens of thousands of dollars more in interest than what you were originally paying. So the next piece that we'll talk about, and I'm going to give you an actual specific idea, is called arbitrage. So arbitrage is utilizing something that you have to help cover or pay for something else. And it's allowing you to expand your net worth by utilizing the assets that you have differently. So we're going to do an actual Q&A on that one here in just a second. Car notes, credit cards, home equity lines of credit, none of those are created equal. So we'll touch on each of those, but really assess the debt you have. Think about student loans, medical bills, all those are different types of loans that are out there, and they all have a different answer on how you would assess them. So remember, I'm going to get in the weeds here. I'm going to get a little bit nerdy on a couple situations because I want you to have some takeaways. This is not going to be all encompassing. This is not going to cover every type of debt navigation. What it's meant to do is get the wheels turning so you can think, okay, there's different ways to approach this. And if you need to have more specific conversations, that's what we're here for and why we're here to help. So I'm going to talk about the first scenario here. We've been seeing this a lot. This is an actual true client. I met with them about 3 months ago, and we ran through a mortgage situation. So when they came to us, Bob and Jane Doe, protect the names of the innocent here, they're both 45 years old. They bought their house back in 2021 for about $300,000. Okay. They took out a 15-year fixed mortgage at 2.25% interest. They literally bought right before interest rates skyrocketed. So their monthly payment that they're making is $1,965 a month. That's what they're paying right now. Fantastic interest rate. About 2 months after they purchased the home, they inherited about $600,000 worth of AbbVie stock. So they had one of their parents passed away. They inherited some AbbVie stock that their parents had held for years and received it. It was after tax. So they got what was called a stepped up cost basis. So AbbVie at the time is paying about a 4.1% dividend. So you can see the math on the screen. 600,000 times a 4.1% dividend means the dividend was paying $24,600 a year. They just started receiving this. Okay, that's $2,050 per month that they were receiving in dividends. When Bob and Jane sat down with us, their immediate reaction was, I want to pay off the mortgage. And I asked the question, why? Just like I would ask all of you. I don't want you to hold debt. But remember, there's abilities and opportunities for everything that you do. So with Bob and Jane being 45 years old, I said, what is your real goal with the house? Well, they want to stay in the house forever, and they want to retire at age 60. That's their goal. That's why they did a 15-year fixed before, was to have the mortgage paid off when they retire at age 60, because at that point, their pension will be fully vested and all of the dominoes line up in a row for them. So I brought the opportunity to the forefront where I said, if we sell $300,000 of your AbbVie stock, it's gone. If you place the trade, you sell it, and you pay off the mortgage, you have no mortgage, but what you're doing is you just lost $300,000 of your liquid net worth. So when we looked at it, it's just looking at the assets differently. Their cash flow was very comfortable before they inherited the $600,000. They wanted to continue to hold the AbbVie stock. So I said, if you're going to continue to hold the AbbVie stock, and this is an open-ended question to all of you, is those dividends are going to pay and continue to pay every quarter, just like they have in the past. And you're taxed on your dividends, whether you reinvest them or you take them out. And they said, yes. I said, so if you're taxed on your dividends, whether you reinvest them or you take them out, why don't we use the dividends to cover your mortgage payment? Now you have the mortgage going down every single month at a historically low interest rate. You have the equity of the home growing over time, and you still have all of the liquid net worth of the AbbVie shares that you started with. So think about it. They have $600,000 in AbbVie stock. It's paying them a dividend of approximately $2,050 per month. Their mortgage payment is $1,965. That freed them up the ability to now start investing the $1,965 a month. So the mortgage is completely paid for. They're not spending any of their principal. They're utilizing just the dividends and interest. That $1,965 a month, if they invested it and got a 6% return over 15 years, is now worth $462,000. So think about what this just allowed them to do. They now have an asset that's grown to $462,000 by saving their mortgage payment. They didn't spend any of the principal of the $600,000 original investment, and the house is 100% paid off by age 60. So in this example, the debt that they have is good debt, and the inheritance that they received allowed them that domino to start tipping over all of the pieces, right? Because before they didn't have the dividend. But when they inherited this asset, they were going to sell 300,000 of stock, pay the house off. Well, you think about it and do the math. If they sold 300,000, all they're freeing up is the $1,965 a month in payments. It would take them 12 and a half years of saving this just to recoup the 300,000 they put down. In addition to that, that's half the dividends they would have received because they sold the stock. So they just cut their dividend check in half for 15 years. So there's all these different pieces that need to line up. But here's an example of a person who took their wealth and not only made it better, they made it extremely efficient where they're coming out ahead from a net worth standpoint and really putting them in position to win in retirement. The next scenario that we're going to go through, and same thing, I know I'm going through these fairly quickly because these are very in-depth. So if you do have questions or you have a specific comment you'd like to make, please put it in the Q&A section and we'll make sure we cover it at the end. Next scenario that I want to touch on is a client who had a medical emergency. So we'll call her Ruth in this example. So Ruth was a little over age 59 when we got together and we started working together. And her goal was she wanted to retire before 60. So we were really in the midst of doing her, retirement plan in depth. So she's a single individual. She makes pretty good money. So she's in the 25% tax bracket currently. But she did not have much in liquid savings. So she went through a pretty ugly divorce and she was paying off all of her children's student loans. So that was something that she was committed to. She did not want her kids to be saddled with any student debt. So all of her extra income was just going right out the door, paying down these student loans. She wanted to do a marathon. And for those of you that are marathon runners, more power to you. It's amazing the training that goes into that. It's just crazy. I don't know if I could ever run that far. So more power to you. But while she was training, she got a hairline fracture and broke her leg in October of that year. So she called me up, said, in her mind, she said, I'm going to have to work another year. She said her insurance that she had through work was not great insurance. And because of the procedure she needed, she wanted to have a specific procedure done that the doctor recommended. She had about $25,000 in medical bills that were going to come due because that insurance wasn't going to be fully covered by the procedure wasn't going to be fully covered by the insurance. So she really, in her mind, thought this just set me back a full year in retirement or of retiring. And she was really down about it. I mean, she was really, really down. And when we looked through her situation, we had a conversation and really it was looking at her whole picture. And this is what I need all of you to do when these situations come up, or if you're talking to family and friends, it's the same thing. You got to look at the entire picture. So the big piece that we need to look at for Ruth is what does retirement look like for her? The reason she wanted to retire at 60 is she was going to be fully vested with her pension. And she was also going to have the ability, starting at 59 and a half, to touch any of her IRAs, pre-tax money without a penalty. So that was the big driving force behind her. And she was a really good saver in her 401k, in IRAs, things like that. She just didn't have good savings built up because she was paying her student loans off for her kids so quickly. So as we looked through it for her, I told her in this situation, you need to take a loan from your 401k to pay off your high interest medical debt. Now, loans from a 401k are not the cure-all or answer to everything. That is not what I'm saying. But with a 401k loan, what you're doing is you're paying the interest back, but it's getting credited back into your investment account. So think about it. Ruth is 59 and 3 months right now. She's making contributions to her 401k, but she's planning on retiring within the next, 5 to 8 months. If she's putting in $1,000 a month for 5 more months and she's at the end of her career, that $5,000 that she's putting away isn't going to move the needle one way or another because there's no time of growth before she would start utilizing it for retirement. It's not going to move the needle a whole lot. So for her, what hurt her cash flow and in her mind where her hurdle was is she said, I have this $25,000 I owe at about a 14% interest rate. And I need to pay that off before I can retire because that will be paying, over $1,000 a month towards this credit card, or excuse me, towards this medical debt. How can we do that? So the first thing I said is take the 401k loan and let's pay off the higher interest. So for her, the way the 401k loan works, she took a $25,000 loan, paid off the medical expenses, and what it states is that she needs to make a payment back each month to the 401k company while she's working. That's the key piece, while she's working. So she's still working. What she's doing is she was putting that $1,000 a month that she was putting away towards her 401k, approximately $500 of that was going to repay the loan. So $500 every single month, a portion of that was interest. She gets credited the interest versus paying a bank the interest. So she's making a little bit of money through this transaction. She's just not purchasing as many shares as she was before because she's paying back the money that she took out. Well, remember, this happened in October. And I said, you know what, Ruth, based on everything you have, you were in great shape to retire at 59 and a half. So for her, we decided that she would retire in January of the next year. If she retired in January of the next year, which was 3 months later, she was over the age of 59 and a half at that time. So there's no longer an early withdrawal penalty if she stopped making payments on the loan. And she's now in a lower tax bracket because she's not going to show the same type of income that she showed while she was working. So her marginal tax bracket dropped from 25% to 12%. And when you retire from a company, if you have a 401k loan that's in place, you can either continue making payments for a set period of time, or they'll count the loan as a distribution or a taxable event. So for her, she owed about $20,000 when she officially retired. And we said, show that as a taxable event because it ultimately was only going to be taxed at a 12% bracket instead of 25%. So for her, she was able to save substantial amounts of interest. She was able to retire when she wanted to retire, and she saved about 13% on taxes. So you just have to look at the full situation when assessing the debt that's at hand. The last scenario that I'm going to go through here today is around credit card debt. Same thing. This was a real client that we work with. They came to us and they got a little bit behind. So Phil's a single gentleman. He's about 55 years old. We sat down together. He had about $20,000 in credit card debt, and he was paying about 21% interest on them. So that's a lot, right? I mean, you think about it. It's really hard when you get to a point where you get behind and interest is that high. to claw your way out, because every time you make a little bit extra payment, all of a sudden the interest rate is there and it's just putting you further and further behind. So he didn't own a home, right? One of the things a lot of people will look at is, okay, you know, if I have a home equity line of credit available, you know, maybe I take a home equity line of credit to reduce the interest rate, or maybe I take out a 0% interest credit card and I start to play the juggling game, if your credit allows, where you're moving money from one card to another. You know, maybe I could take a 401k loan. In this example, Phil was behind in terms of retirement savings. He needed to save more for what his goals were. So he was adding to a 401k, and he had about $400,000 in that 401k, but he was behind pace for what he felt he needed to be at in terms of income for retiring at 65. So I didn't want to see him take a loan from his 401k, because he would be contributing to it, but a portion would be just paying himself back, and it would be less contributions going into the actual 401k. So it would slow his growth. I did not want to see that. As we sat down, though, he had an old whole life insurance policy that his parents had actually started for him years and years ago, and he took over the policy. So it was a policy that, you know, they had held, where it was, you know, something that allowed, if he needed distributions, or if something were to happen, he was guaranteed insurability, and the policy was extremely old. So he had a cash value inside that policy of about $35,000. And we see this quite often. So a whole life insurance policy, or a VUL, which is variable universal life, they're great investments if they're utilized the right way. For Phil, he had been making the minimum payment for years and years and years, probably 40 plus years between he and his parents, had been making the minimum payment into it, and it had built up a cash value of $35,000. Phil's a single guy with no children. And I said to him, I said, based on what you have with the whole life insurance, this has a $200,000 death benefit, and it had death benefit option A on it, which means when Phil passed away, the cash value would be kept by the insurance company, and the beneficiaries would only get the death benefit of the $200,000. So I said to him, I said, you have $35,000 in cash that's available now that has no impact on your death benefit, and your premium that you're paying per month will not go up. So I said, let's call over to the insurance company, because with insurance, you can always pull out your basis, meaning what you've paid in over the years. You can always pull that out tax-free at any time without any penalties. So as we dove through it, we looked at it, we called over to the insurance company. Over that 40-year period, they had paid in over $42,000 in premiums over that time period, and there was a cash value of $35,000. So what that allowed Phil to do was take a $20,000 distribution from the insurance policy, tax-free, pay that off, still have the insurance policy in full effect for the $200,000 death benefit, and give him a little flexibility that if he needed to take a distribution in the future, he could. So it's just assessing the situation. Here, Phil thought he was behind the 8 ball, and he was going to have to keep making payments for years to come. And we were able to get that paid off in a 1-month time period and ultimately do it tax-free. And that's the key piece that we're looking at. So tools to pay off debt, things that I want you to think of when people talk about debt. So a debt snowball, that's a powerful tool. We didn't even talk about that today. So a debt snowball is looking at the accounts that you have. So let's say that you have a credit card for $15,000 that you're paying $1,000 a month on. And let's say that you have a small loan on your car that's for $3,000 and you're only paying 5% interest. Well, a lot of people think, well, I need to attack the credit card aggressively because it's at the higher interest rate. And normally that is right. But when the balance is that small on the car, and let's say you're paying $500 a month, pay off the car first because it gets the snowball started. It frees up the $500 a month of cash flow that you can then attack the credit cards with. So it's called a snowball. It's taking one debt, applying it to the other, paying it off, applying it to the other, and continuing and continuing. After tax accounts, I built out another scenario in here, but I took it out just for time's sake of utilizing after tax accounts. I met with a client about a year ago, and they wanted to pay off their car. They just wanted to be debt-free going into retirement. That was their only remaining debt. And they're looking through their situation. I don't want you to pay taxes on something. I don't want you to take a distribution from your IRA right now. And we looked through their whole plan, and they actually were Walgreens employees. And what's interesting about it is Walgreens at that time for the employee had a cash pension plan. So the cash pension plan was actually just building cash that they could take out at any time. And since they were over 59 and a half, there was no penalty. And they were able to take that cash and utilize that cash to pay off the vehicle. So it's just looking at that whole situation. You know, a lot of people will play the 0% interest credit card game, right? Put it on a 0% interest credit card. You have 9 months to make payments, and then they get another one, and they keep doing it. So that way they're not paying interest. That's one of those situations where if you don't have any of these other assets, you can look at it. 401k loans, if done properly, are a really powerful tool, but I do not want to see everybody going and taking 401k loans. It can really be a detriment to your wealth. It's a tool that can be used in the right situation, and you want to discuss that in detail with an expert first. Home equity lines of credit, these can be nice vehicles too, right? You have a lot of equity. For a lot of people, their house is their biggest asset, right? Or their biggest net worth on their balance sheet. And unlocking some of that equity can be utilized. There can be some tax advantages with that, and you can deduct interest as long as it's used for the improvement of the home. That's the key piece. Stock options and RSUs. So if there's anybody on here from Abbott, AbbVie, or any Fortune 500 companies that, you know, has stock options or restricted stock units that are coming due each year, what a powerful tool to utilize, right, to pay off debt if need be, right? When an RSU, restricted stock unit, vests, it's already running through your W-2. You could literally sell it that day, and it's a neutral tax impact, and pay off debt if you needed to. Another piece that people don't think about a lot is if you work for a Fortune 500 company and they have stock that you can purchase inside of your 401k, even prior to age 59 and a half, you can pull the dividends from that stock out of the account. That can be used, right? We don't want to use that in every situation, but that can be used to help pay off debt very quickly. So if you had, you know, an account with $500,000 of a stock that paid 4%, well, that's $20,000 a year of dividends you could take out. You'll pay taxes on them, but you won't pay a penalty. And you could pull that $20,000 out to help pay off debt. And then life insurance, like we talked about, that's another underutilized vehicle that can help reduce that debt load or that expense. So with that being said, I hope this brought some tremendous value to you to just see how some of these concepts can be understood outside of just your normal, you know, just work another year or pay this off. So with that being said, I'm going to set a couple minutes aside here. If we have any questions, please feel free to click on that Q&A tab below, and Jenna will read off those questions and we'll get them answered for you in a timely manner.
There currently are no questions that have been submitted so far.
All right. Well, that means that either everybody is ready to rock and roll because it's a Friday and going into the afternoon, or we went through a whole bunch of concepts and it was drinking from a fire hose. So I'll think of the second there. So if you guys do have any questions that come up after the fact, please feel free to reach out. This was a little different webinar. I hope you enjoyed it, and hope you have a great rest of your week.